Hello there, everyone. We're glad to begin the session proper. Thank you so much for joining us and welcome to the third session of our Sustainability Dialogues, looking at a better future in Asia through the lens of ESG funds, organized by the AVPN Climate Action Platform. I am Patsian Low, Chief of Staff and Head of Platforms based in our headquarters in Singapore. We are really excited to organize this event and galvanize conversations on ESG because of the vital role it will play in the future of our planet. Our first session of the Sustainability Dialogue series began with looking at the larger ESG landscape in Asia. These past 2 pandemic years have also taught us that sustainability is not about tackling environmental risk as the issue unfolds only, but really looking about creating resilience into infrastructure. And this is where, as we advance in Asia, the topic of ESG, sustainability, and impact investing has come into prominence. So for those of you who don't already know AVPN, although I'm sure many of you already do, we are a network of funders and resource providers with over 600 members across 32 markets. Our mandate is to move more capital towards impact in Asia by providing social investors like yourselves opportunities to connect, learn, and lead. A few housekeeping announcements before we start the program proper. Please note that this session will be recorded and you will be able to access the recording from our website approximately a week after this session today. We have also set aside time in the program for Q&A, so please provide your questions into the Q&A box, which you can access by clicking on the icon at the bottom of the screen. Please note also that you are able to upvote on questions that are submitted by other participants. And on our end, we will do our best to answer all questions submitted during the session. So we apologize in advance, though, if due to the interest of time, some of these questions may not be answered, and we will do our best to also follow up on them in writing after the event. If you have any technical queries, do also add your comment in the chat box, and we will respond as soon as we can. Now, let me just quickly set the tone for what we'll be talking about today. As the pandemic rages on in many parts of the world, and climate change is manifesting in disasters and weather patterns changes, causing unprecedented damage, many investors across the region are taking a stronger interest in the opportunity to create impact and sustainability through their investment capital. Many surveys and research have reported almost $5 billion in inflows to sustainable funds in the region for the as recent as the fourth quarter of 2020. Which boosts total ESG assets at the end of the 2020 year to more than $25 billion, an increase of almost 131% over the previous year. However, there still seems to be some level of unevenness around how the Asian investor is regarding ESG and sustainability investing. And this is something that continues to be a challenge that faces many of the early trailblazers in ESG and sustainability investing, while they are looking to engage more interest in not just sustainability from an investment approach, but also balancing it against their desire for financial returns. Whether it's tangible or intangible, many different issues have emerged in our conversations with social investors to understand what will catalyze and motivate their investment into ESG. And today we are looking at perspectives from ESG funds, as well as what may be interesting perspectives for investors that are looking to enter into investment in sustainability and ESG through funds as the primary vehicle. So today we would like to welcome a really exciting set of speakers to join us to uncover what are the important points to bear in mind when we're looking at investing in ESG through funds, understanding the strategies, the considerations when assessing and adopting these ESG and sustainability frameworks and vehicles, and also knowing what kinds of best practices have been adopted as ESG funds are launched all over this region. So let me introduce our panel very quickly. We're really excited to have them join us today, and as they are experts in their respective fields. We have Praveen Jagwani, CEO of UTI International. And Praveen, if I may ask you to turn on your camera. Thank you so much. We also have with us Stephanie Bilo, Chief Client and Investment Solutions Officer at responsAbility, coming to us from Europe. Hello, Stephanie. And we have from Australia, Mr. Tim Macready, who is the Chief Investment Officer at Brightlight Investment Management. Thank you so much for joining us, Tim. And I thank you in advance to all of our panelists here to joining us today. So we're going to dive right in. I would also like to encourage that the audience should feel free to pop in questions as the session is proceeding, although we may only address the questions later on in the agenda. So let me start first by jumping in with an introductory question for Praveen, and I would very much welcome you to introduce a little bit more about UTI as well to the audience. Please tell us a little bit more about what ESG investing landscape looks like now in India, which is the primary footprint for your organization.
Thank you, Patsian. I'm delighted to be here speaking with all of you today. First, a little story. When I was born, many decades ago, my father bought an investment fund in my name for college education. There wasn't much of a choice those days in India because there was just one investment firm. It was UTI. UTI is an acronym for Unit Trust of India. In 1964, after India's independence, when the government decided to create asset management industry, UTI was born. And a few years later, my father bought this fund for me, as did most fathers in India for their children. So UTI is a powerful financial brand in India. Fast forward 57 years, today we manage 160 billion US dollars across pension mandates and mutual funds. I have been with the firm for 13 years and I'm responsible for global sales and marketing. We have a very good progressive culture and I love what we do. Our journey in ESG started in 2016 when we signed up to UNPRI. And honestly, on some days, it still feels like holding a tiger by the tail. In the country, in India, ESG as a movement is in its infancy, which is good and bad. Bad because we are light years away from the standards expected by first world investors. But good because of the low base effect. Every little effort in India gives you remarkable improvement in ESG scores. There's a lot of work being done around stewardship, sustainable development goals, renewable energy. But I'm going to mention just two things to give you a bit of a context. First, India has made a net zero commitment by 2050, which, as you know, is 10 years ahead of even China. They are at 2060. And second, the capital markets regulator has taken the lead to create an ESG reporting framework. It's called the BRSR, the Business Responsibility and Sustainability Report. It is mandatory for the top 1,000 listed companies to issue this report annually. And this report is a bit of a, as if a cat has been thrown among the pigeons. Every company is scrambling to understand this genius document. I'm not being facetious here. It is genuinely a fabulous document. 35 pages of very detailed ESG disclosures. And as you would expect, some companies in India have globally benchmarked ESG practices, while others have no clue. A CFO of a small company called up one of our analysts to ask, what is differently abled people in the employee base? Do they want their educational qualifications? This is for a question on the employee diversity on page 3 of the BRSR. So differently abled, that's just a novel phrase in India right now. But suffice to say that the top 1,000 companies in India are working feverishly to compile this report. It will be a game changer. So expect material improvements in India's ESG footprint this year and next.
Exciting, and I really like your description, Praveen, when you talk about things like catching a tiger by the tail and setting a cat loose among the pigeons. Quite clearly, it's going to be creating waves, albeit in an environment in India that is, on the one hand, very exciting for its opportunity, but also could potentially signal some changes as growth accompanies that type of investment appetite. We'll come back to what the implications are for investors or other asset holders and maybe looking at funds to enter the market. But I'd like to shift to Stephanie, if I may invite your perspective, Stephanie, because you are in Europe but you operate over a wide variety of geographies. Tell us a little bit more about responsAbility, and maybe because of your global profile, we'd love to hear more about the kinds of investor types that responsAbility works with around the world, but also more particularly, what are some of the interesting observations you have about the ESG landscape in Asia? Stephanie, you may have to unmute your microphone. There you go.
Thank you, Pat. Yes, absolutely. Thank you for the kind words. Yes, we are a global player, an asset manager based in Switzerland. We are a sustainable investment house that specializes purely on impact investing. So that means 100% of what we do is investments for a sustainable world. And yeah, currently these topics are quite obvious. The most important issue we already talked about is obviously climate change, but it's just as much social issues with regards to the human being. And there you can face anything from inequality to non-existent essential services and goods access for people. So we invest into those topics. We invest for a clear outcome to improve outcomes in the future. Our asset manager has been in existence for almost already 20 years, and we've always focused on these three different areas: climate change, financial inclusion, so access to financial services for people, but also the third area, which kind of links the two of these in a very natural way, is sustainable food, because it's becoming more and more clear that you can only do really good if you also have a sustainable value chain. It's become also very clear in the COVID times. So we do that only in private investments. We focus globally, have 10 offices around the world, and 4 of them in Asia, and we do a lot of different type of investments for these kind of strategies. And the type of investors that actually have the money with us are also very heterogeneous, because what we've always said is we want to focus on these outcomes, but we always wanted to also achieve a risk-adjusted return that is attractive to normal market participants in financial markets. So that means we've mobilized a lot of capital out of the private markets, but at the same time, sometimes we do new strategies where we work with development finance agencies, where they support us in a new particular area, something like access to clean energy. And then once we've proven the concept of the investment thesis, we bring in more private capital. But we also have ultra high net individuals. We have institutional clients who work with us and given us big mandates. And we've also have, as I said, we also work with governments to formulate a specific outcome that we want to reach with our investments. And we have this all in over a dozen different funds in private debt and private equity.
Sounds like a really exciting outreach as well, quite diverse based on what you're saying. And it sounds like also responsAbility is looking to bring new strategies to this diverse set of investors as well. Would love to dive more deeply with you, Stephanie, later on in the session about what are some of the observable trends that you're seeing also in terms of how the responses to these strategies in Asia. But let me shift to another part of Asia, which we seldom talk about, but I think it's important for us to understand better, which is based out of Australia. Tim, welcome. I'd like to maybe just ask, perhaps from your vantage point in Australia, having perhaps arguably slightly more and longer sustainability and impact investing experience as a market relative to the rest of Asia as well. Tell us a little bit more about what Brightlight's been doing, and more specifically in the Brightlight context, what are some of the early observations or lessons you've really seen starting out with the work, the trend for ESG and impact investing in Australia?
Yeah, pleasure to be with you all. So Brightlight is an investment advisor and fund manager. We're focused solely on responsible ESG and impact investing strategies. And our work helps clients across Asia Pacific to align investment strategy with their values. So for some clients, we get brought in to help develop an investment policy that takes ESG or values-based investing into account. Other times we might review a specific impact investment opportunity. Sometimes we get brought in to advise across a client's entire portfolio. And that means we work across the spectrum of ESG, responsible, sustainable, and impact investment products, and across the full range of asset classes. Designing and implementing responsible investment strategies. That means we look at a lot of external managers and how they're approaching implementation of ESG and responsible investment strategies in their portfolios. And so in terms of what's happening in Australia and indeed the region, we're seeing really widespread adoption of ESG practices by funds. Many managers and many asset owners are signing up to the Principles for Responsible Investment. Most Australian super funds, for example, are PRI signatories. And so there's lots of people implementing some type of responsible investment approach, but there's a lot of dispersion in what that approach actually is. We see lots of funds using screening strategies, for example, but with significant differences. Some funds just screen out things like tobacco and gambling. Other funds might exclude fossil fuel producers and sometimes even exclude banks that lend to fossil fuel producers. And similarly, when it comes to not just exclusion-based approaches, but integration of environmental, social, and governance factors into portfolio management, again, we see a lot of dispersion. We see some managers applying very light touch tokenistic approaches, while others are diving deeply into ESG. Similarly, with impact investment strategies, lots of interest in Australia and the region from family offices, foundations, and values-led investors in allocating to high impact unlisted strategies, but wide dispersion in relation to the quality of impact that you see out of those strategies, and in fact, whether impact is even being measured at all in any way in some of these strategies. And so those early lessons are starting to really come through for the field in terms of the differences between the high quality ESG and impact approaches and the tokenistic ESG and impact approaches.
Tim, I think that's really interesting. And if I also reflect back on what Stephanie had just mentioned, it sounds like the diversity of the Asian marketplace, and not only just in terms of the investor type and what they're looking for and the strategies that they're deploying, but also the diversity of the market itself in terms of the opportunities that are being presented isn't really helping this dispersion challenge that you're seeing also. So maybe I can shift gears back to you, Praveen, because you've been working with funds that are active in India, one of the biggest impact markets in this region now for some time. And certainly you are also encountering some of these dispersion type challenges that I think Tim is talking about. Tell us a little bit more about how UTI integrates ESG into some of your funds and your strategies. How does it look like when you are also deploying these strategies and introducing them into both the way that your investments are happening as well as how you're speaking to investors? What has been the response? What kind of opportunities and challenges did you come up with when you were implementing UTI's ESG policy? Tell us more.
Right. So our ESG policy is really lovely, a labor of many thoughtful minds, but honestly, when it really comes down to brass tacks, it is like any other really. They all look the same. If you've seen a few, then you've seen enough. So I'm not going to delve into the minutiae of our ESG policy and bore everyone. The more interesting bit is, like you said, Pat, how we apply it, particularly in our private credit fund. So in our private credit fund, we give loans, growth capital to profitable mid-market companies in India. And they're still reasonably small by global standards, but at senior secured level. We lend to companies in 4 sectors: education, healthcare, renewable energy, and agri-food processing. Now, as you hear the sectors, they are very intuitively ESG friendly. Because there's been such a plethora of standards and frameworks, we decided to develop a proprietary ESG measurement tool together with Pricewaterhouse. So when we start looking at any potential deal, we conduct an ESG audit, apart from the credit evaluation. The ESG audit checks for regulatory compliance, adoption of ESG ethos in all areas of the company, product labeling, anti-corruption, all of those. we look for these embedded in their operating procedures and manuals. Most often they don't have these manuals, so we create these if we are to lend to them. It's a 100-point scorecard, and say we are evaluating an engineering college that needs expansion capital to create a new research wing. On the ESG audit, say this engineering college scores 45 on 100, we tell the college that if they want our loan, they must improve their score to at least 55 before we go any further. So even before we have lent them a single dollar, we make them more compliant. If we decide to go ahead with the loan eventually, we then actively engage with the management to devise an ESG improvement plan and build it into the loan agreement. This makes performance of ESG objectives legally binding on the company. Typically, an improvement plan would say that the college must do specific things to improve their score to say 60 within 90 days, to 75 within 180 days, and to 80 within 1 year, so on and so forth. If the company meets these milestones, we could reduce interest rate by 50 basis points. If they fail to meet the deadlines, we increase interest rate by 50 basis points. So it's like carrot and stick. So in this manner, we bootstrap these businesses into becoming more professional and sustainable. And we give our investors an annual improvement report card on each underlying company. In terms of barriers to capital, I'd say there are two kinds of investors in the world. Those who want a better world, and those who want a better product. The latter wants ESG labels and exclusions and conformity with some IFC or norms or GRI, SASB. They tend to get lost in the 50 shades of green, trying to pick the darkest green. While those who want a better world, we are more aligned with those investors because they take the time to understand what's really crucial: intent of the asset manager, the process, and the results. And that's what we do, trying to bring them to India, helping small businesses become more resilient.
Thank you very much, Praveen. And the approach that you're taking in the context of developing a proprietary scorecard that you then use also as a way to incentivize the investees to become more sustainable is something that I find particularly intriguing. And I wanted to take that point and maybe come to you, Stephanie, on this, because you are looking at multiple markets and also multiple investor types. And I know when we spoke about this previously, we made it a point to discuss the difference between devising and designing what the strategy is, but then also subsequently implementing ESG selections on the investees that will go into the portfolio. Tell us a little bit more about how responsAbility is approaching that. You've heard what Praveen had to share from his own funds. Love to hear from you as well.
Sure, thank you. I think it's quite important to make the difference there between the impact and ESG selection criteria and measurement. What we do at the outset, before we actually invest, before we formulate the fund strategy, before we formulate the investment strategy, we define what is the impact we want to achieve. And typically we focus there on, say, some of the most important sustainable development goals, like no poverty, well-being, access to clean energy, or sustainable agri and food chain, things like that. We take it and formulate what type of outcome do we want to achieve. And then we go about to select the respective portfolio strategies, portfolio companies that will help us to achieve that. And let's take an example of the bond that was, for example, just issued a month ago with the Swedish government. We issued a 175 million bond that has 3 different goals in terms of impact strategy. It has access to essential services as an outcome, affordable business infrastructure, and employment generation, improving livelihood of human beings. So these 3 core components then define what we actually invest in. And each of the portfolio companies, then we again score for ESG criteria, very much like Praveen mentioned it, with regard to a scorecard. We kind of evaluate on social, governance, and environmental impact each company, how they operate. And it doesn't mean that these companies need to be perfect, not at all. I mean, standards vary massively across different regions. But what we need is an entrepreneur that is willing to work with us towards a better ESG criteria at the end of our investment life cycle. So that's kind of then what we formulate in terms of ESG criteria, and have also a proactive engagement with the investees with regard to how they can improve on that level. So these kind of are the differences. And let's take the example. Okay, so we have the target access to essential services. What type of investments did we do? We, for example, supported, we're financing now a hospital in Vietnam. They have just built a new wing and have great facilities which not only give access to Vietnamese people under the normal healthcare scheme, so it is available also to the poorer people, but it also has quite a sophisticated COVID treatment facility, one of the few in the whole country, and also cancer treatment facilities. So this kind of investments we did under the social bond, where the Swedish government actually helped us issue that type of bond to institutional investors with a partial guarantee with regard to potential credit losses in such a very global, diversified portfolio of investment companies that we did.
Thanks very much for sharing that, Stephanie. And it sounds like, you know, in addition to, of course, designing what the strategy would be for the fund, how we then translate that into some very clear, sustainable, outcomes-driven type goals or targets that will then be tangible ways for you to filter and select for the appropriate investee is a very intentional, but also a very deliberate process that responsAbility and potentially even your other partners like the Swedish government in that particular bond issuance we need to be involved in. And I would be also very curious to know how the engagement of a partner like the Swedish government may have changed some of the dynamics of this this instrument, and we can come back to that question. I just wanted to pick up on the point though about the selection and authenticity of ESG practices, and I wanted to come back to you, Tim, because you mentioned earlier that you Brightlight looks at a full range of investments in your fund, ranging from direct investments as well as external funds as well. You mentioned dispersion. Now, not only do we have a dispersion of practices, we potentially also of standards or benchmarks, we now potentially also could have a dispersion of different types of frameworks that investees or funds may be applying to share with you the authenticity of their ESG achievements. Tell me a little bit about how Brightlight navigates through that, and how do you make your selections and verification accordingly?
I love what Praveen shared earlier about the way that they've developed their ESG approach, because it's so clearly been developed and customized in the context of their role as a lender and investor. And that's what we're looking for. We're looking for, particularly when we're assessing external fund managers, but also in direct opportunities, we're looking for an approach to ESG and impact that has been tailored and customized to the manager's strategy and to what the manager is trying to achieve. Many times you'll see someone with a standalone set of ESG analysts or an ESG team, and that's a good thing. But if they're not integrated into the portfolio management team that's making day-to-day decisions about the portfolio, then it's very easy for there to be this disconnect between what the ESG analysts are thinking and then what happens day-to-day in the portfolio manager. When the portfolio manager is making their decisions about buying and selling and holding companies. What we like to see instead is this integration, whether there's an ESG analyst and a portfolio manager, or whether you see in some managers the portfolio manager given deep ESG responsibilities. If you see integration there, then when the portfolio manager is speaking with companies, they can seamlessly move between broader business issues and ESG matters quite quickly. And that starts to play out then in the way that they engage with their investors, as they provide reports on their engagement activities, as they provide examples of companies they've chosen to invest in or influence because of ESG issues. When they've seamlessly integrated their ESG practices, you can tell the difference as compared to a manager that hasn't done so. We think that the best managers also report on their activities, whether that's screening or engagement or ESG integration, or indeed reporting on actual impact outcomes if they're claiming to be generating positive, tangible impact. In terms of kind of verifying and getting a sense of how a manager's performing, when you talk to a lot of managers, it does become easier to distinguish between greenwashing or marketing spin and managers that genuinely care about ESG and impact. And then over time, you see it in their reporting, you hear it in their conversations. It's a regular feature of their portfolio updates, for example. You don't have to ask for a separate ESG update because the portfolio manager is just building that into every conversation with you.
And I think just to your earlier point, Tim, if you do see that kind of integration or alignment between the ESG and sustainability practice with the investment practice, then a lot of that will come out quite naturally over time as well, particularly in reporting and also in engagement with investors. I think that would also lead me to a set of other questions I wanted to ask the panel, really to share a little bit about what you're observing on the ground in terms of how the investee community is responding to this trend, and as you are bringing your frameworks and your approaches to the investees as well, and likewise also how are the investors themselves actually responding. Let's be honest in sharing some of your experiences also where there has been a great conversation, or perhaps where it may have been a challenging one. Maybe I'll start with you, Stephanie, and I'm happy for Praveen and Tim to also share your perspective from the investee lens. Practically speaking, what does it look like now when the investees themselves or the companies that you're financing are adapting these tools, to be part of your portfolio and to be working with your capital? What are some of the challenges or developments that you're seeing that will be important for other investors to bear in mind? Maybe Stephanie, I'll start with you, and I'm happy for Praveen and Tim to chime in.
Yes, thank you, Patsy. I think I want to actually first address quite a fundamental thing. Do we kind of believe ESG and impact is a concept of the West, and is it really transferable to actually an Asian market locally? How do we work here locally? And isn't that kind of limiting ourselves to making good and sound investments? I think that's one of the fundamental questions that I come across very often with traditional mindset investors. Like, how can you actually make impact strategy without actually limiting yourselves in terms of universe, in terms of opportunities, and actually will you make less money because you go after an outcome oriented strategy? And I believe there is really the crux of a good investment manager, by selecting investee companies, working with the investee company, with the entrepreneur very closely together, and looking at all stakeholders in that value chain of the business model of that particular investee. Okay, who is profiting if we change this type of strategy? Who will be profiting if we actually work towards proactively towards that type of income? Now, for some of the investees, this is a very easy model. Let's take one of the largest solar panel producers that we have been financing from very much the beginning, like Fourth Energy Partners in India. These guys obviously do work towards a low carbon emission economy in India, and also now expanding to the Southeast Asia. So for these guys, it's quite obvious. Yes, we have a very clear outcome. We want to achieve that. We work with all our stakeholders who want to achieve the same thing. But it might be quite different for an entrepreneur, for example, in the food value chain. There you need to analyze much more closely the different participants of that value chain, who is profiting from which activity. So let's take, for example, a producer that we are financing, who actually exports cashew nuts, fruits, and spices around the globe. These guys have taken as a business model that they want to only do organic farming farm produce. And actually, the way they build the model is that they first educate smallholder farmers, and then also give them seeds to actually then grow it and finance them with regards to actually only bringing in then paying them beforehand, and also guaranteeing them a special price. They can also sell it to the market, but they will always kind of offer a better price because they are paying for the organic produce. So there you see, by actually putting themselves in the middle and really thinking, okay, how can we make sense to this, the smallholder farmers, but how can we also produce a better product for the more and more demanding consumer that wants sustainable food, that wants nutritious foods, and of course, it needs to be safe as well. So I think that kind of shows neatly how everybody in that value chain can profit from a better or from an outcome-oriented investment strategy.
I think that's a really, really important point, Stephanie, considering that there is an increasing trend of sustainability and ESG investment funding sources that are stemming from the international investment community looking at this region. And it sounds like in what you've just described that there is that level of deeper engagement that is needed market by market, country by country, even sector by sector, depending on what are the opportunities there for sustainability and ESG impact. Praveen and Tim, a little bit more insight from you perhaps in some of the investee experiences that you already had when they've been working on applying these types of practices in your portfolios. Praveen, maybe I'll start with you.
Yeah, sure. Yeah, I mean, I was listening to Stephanie and it kind of resonates, as she speaks about getting alignment with the entrepreneur to actually be philosophically oriented towards doing good. And a lot of that is just engagement, activism, coaching, and education for them. Because bear in mind that these entrepreneurs, they might be good at what they do, growing cashew nuts, but they don't have MBA degrees from Harvard or Stanford. So their understanding of running a professional firm that outlives their own life, that doesn't exist. So, when we speak to some of these mid-market entrepreneurs and we tell them, you don't have a lady on your board. And the answer is, don't worry, I'll get my wife or my sister, we'll fix it. And we tell them, if you want our loan, the idea is to make you ready to become credit-worthy in front of a bank. So we want to take you to that level, which means we will engage a search firm. We will identify a proper lady with a domain experience in your field. We will appoint her to your board. That's a condition of giving you a loan. So kicking and screaming, we drag these entrepreneurs along into this journey of becoming more resilient and sustainable.
Praveen, I have to say your description is always very, very emotive. I think about it, animals, and now kicking and screaming into this process. But I think it demonstrates that the humanity of this whole approach, right? So Tim, sorry, please go ahead.
No, not much to add. Just very similar experiences. It needs to be contextualized into the context of the company and the country that you're investing in. And as Stephanie and Praveen have just given examples of how that works, would just completely agree.
Excellent, excellent. I think that this is something that maybe we can also address as we answer some of the audience questions. That in a way, what I'm hearing actually is that the diversity of application, contextualization of it, which may appear to be what looks like dispersion or maybe non-standardization, is actually not necessarily a bad thing. It's reflecting on what may be needed in the markets. But let's dive into then, what this could look like from an investor's perspective. So I'd like to then also ask all three of you to maybe comment a little bit. Especially Stephanie, you mentioned earlier that the kinds of investors you're engaging with are quite diverse. And I'm sure between Praveen and Tim, you also have a wide diversity of institutional and private investors that are also engaging with your funds. How do you engage with them to be aligned with the strategies, considering that there is that level of diversity on the ground that you've just talked about? What have been some of the exciting developments that make you feel optimistic about how investors are responding, and perhaps what may have been some of the challenging conversations you've been having with them? Love to hear from you guys more on that. Maybe I'll start with you, Tim, and then we'll work our way through Praveen and Stephanie also.
One of the really exciting things, as someone who's been engaged in this conversation around ESG for 15 years, we're seeing so many more options available for investors. It used to be that if you wanted to invest responsibly or with an ESG lens, then there might be one product available for you, and it was probably a slightly more expensive version of the manager's main fund. Whereas now we're seeing opportunities to express a really broad range of values. We're seeing them in listed markets, in unlisted markets, in emerging markets and developed markets all across Asia, strategies that can work for different clients. So you're not in the situation where if you want to adopt an ethical or responsible or an ESG investment strategy, you're limited to a really narrow range of managers. Some of the ways that we're seeing clients explore that is really moving incrementally. They might start with their listed equities and they might move to a strategy that uses ESG integration, but other than that mirrors the strategies they've already got. And then having I guess, seen success there. And of course, with each year that passes, there's more and more academic studies coming out showing that responsible and ESG investing performs as well or outperforms broad market investing. But as they get confidence, as they have experience in moving into ESG strategies, they might start to adopt some targeted emerging market strategies, or they might start to venture into the unlisted markets, into some higher impact strategies. And so the challenge, of course, is that that's different for every client, because every investor has a different starting point, different set of objectives, a different set of portfolio constraints and requirements. But the positive thing is there's just so many more options available for people now.
Praveen, how about you? What are you seeing?
I mean, I agree with Tim. There really isn't any discernible trend. You know, forgive me for saying this, but some investors are lazy. They simply want to check boxes on a template, and then then others are completely open. They want to hear your story. They want to be part of it. They want to get engaged in it. I would say, by and large, the institutional segment tends to be very structured in their objectives and processes, driven by an investment committee, all of that. While family offices are very different, because their mandate tends to be a little less prescriptive, and therefore they could get inspired by vastly different opportunities in different sectors, from even from venture cap to late stage in bite sizes. So it's like they have their own priority ordering of the various SDG goals, and then they decide to focus on hunger elimination as against climate change, while others will do different things. Some prefer just listed stuff, green bonds or green ETFs, while others like very specific outcomes in specific sectors like renewable energy. So there isn't any consistent trend. And we enjoy all conversations, investors across the globe. There's so much to learn for everyone.
Stephanie, how about your perspective?
I would still like to give a couple of examples also of some of the more challenging conversation that we had. I think because at the end of the day, if you start from where your values are, then it's becoming quite clear what type of investments you want to make. And they can be very diverse, of course, just as we are all very diverse. So I think that's totally fine. That's what you described, each of you, and it makes sense. Challenges we had, for example, is on some of the fundamental things like how to address climate change issues. Because you, for example, have some of these alliances now where they say like, okay, we want to have a net zero portfolio right now, and we will not invest into companies that actually are heavy emitters yet, still. And I think there you have quite a challenging conversation, because you kind of say like, okay, so that means you will only invest into renewables energy, and you will basically with that, you only capture a very small fraction of the economy, of the emitting economy, and you're actually also capturing only a very small fraction of the solution to climate change until 2050 to reach the zero target. So fundamentally, those values do not quite match with ours, because we take a very fundamentally different approach, where we say we need to work with the whole economy, and we also specifically need to work with the emerging market economy, the growth markets, where there's high emission, and there will be high growth in emission if we don't change anything right now. So we invest heavily into energy efficiency projects across all different sectors, and make sure that we also work with some of the heavy polluters to make them better and to really decrease CO2 emissions. So I think that's one of the fundamental questions that we, for example, had with some of the institutional pension funds and insurance companies. And other challenging conversations sometimes we have with family offices, where some of the family members have very, very extreme views with regard to, for example, the sustainable food value chain. They want to only invest into vegan production. And also there we kind of say, like, okay, this is very interesting, and this is also very innovative and forward-looking, but right now it does not reflect the reality in our emerging markets. So we are probably not a match, because we don't want to limit ourselves to only the vegetarian production. We will also make sure that, for example, milk production is done in a sustainable way, and we also want to look at how is animal welfare right now taken care of in Asia, for example. So these are some of these more challenging examples that we have encountered.
Thanks, Stephanie. Thank you for being honest and in sharing, where perhaps you would have to walk away from some of these opportunities because of that lack of alignment. And I would like to be very optimistically say that it's probably just a matter of time rather than a matter of true divergence between the investor and the fund. I'd like to now flip into some of the audience questions, because there's some really, really interesting ones coming through. And I'd like to just also let the audience know that you may see some of our panelists typing an answer to your question. So especially if we only have limited time. But again, we'll try to address the ones that will be good for our conversation today to dive more deeply. The first one I wanted to pick up is a question from Anuja. Thank you for your question. Does Asia have specific ESG investment trends unique from Europe or US? So for example, are there more based on the pyramid products, or maybe other forms of reforestation products, etc., or other examples you may think of? Maybe I'll direct this question to Stephanie, because you have the comparative lens between Asia and the rest of the world too. Maybe Stephanie can tell us a bit more.
I think one of the unique opportunities right now in Asia is in the sustainable food and value chain, because still 80% of the land is actually worked on from smallholder farmers who own less than 2% hectares, which are 2 football fields basically. And still 80% is farmed by just smallholder farmers. So there is an enormous transformation needing to happen, because at the same time we have very modern consumers moving to the middle incomes sector. 1 billion will be moving there by in the next 10 years, and they will be asking for safe, nutritious and sustainable food, and also actually different type of food, not the rice bowl, but more proteins. So I think there is a unique set of challenge and investment opportunity at the same time that is very, very different in Asia than, for example, in LATAM or even in Europe, US. So we have specific investment funds right now that target just that particular opportunity with, for example, with private equity investments, where we also achieve very attractive returns, because the revenues in those companies specifically targeting that segment have been growing massively in this transformational process.
That's really exciting. And I think coming from Singapore, who had already been looking at alternative proteins for some time, I think this is something really to keep an eye on for this region. I wanted to pick up another question which should make our audience that has analyst background or accounting backgrounds pick up their ears, which is the question that has been raised about the integration of ESG strategies when put alongside accounting standards or reporting standards like SASB, particularly when we look at challenges or requirements around materiality and what is material or not material. In the Asian context, and I'd like to direct this to both Praveen and Tim, what have you seen as being very contextual ESG frameworks, tools and guides that, or even some other minimum standards you may want to suggest that should be brought into the financial regulatory environment? It's a pretty loaded question, but I think it's interesting.
I'm going to make just a short comment here that, in context of all these standards that are coming out at, like fast and furious, they all designed in the West. And the West is reading Shakespeare. In Asia, we're trying to learn the alphabet. So there's just a generational difference in evolution right now. And then, going back to what Stephanie said, like, you have to identify how much progress you want. Do you really want to eliminate parts of the solution? So getting some improvement, whether or not it conforms to some globally accepted standard or not, is still good. It's a good outcome. And something like IFRS is for the accounting world. It's taken years and years to get standardized across the world. So SASB is a newborn baby. It'll take multiple iterations and to evolve and for global acceptance. And Asia, it'll definitely take its time.
Two very quick comments from me. One, it's going to be interesting to watch the impact of the European Sustainable Finance Disclosure Regulations, which I think are going to have a significant effect on transparency and really start to reduce the extent to which we have greenwashing managers claiming that their investments are sustainable when they're not. The other thing with a specific kind of Asia-focused hat on, I think there are areas where Asian investors and particularly investees are leaping ahead of particularly some parts of the West. If you look at private equity, for example, something like 2% of private equity in the US goes to women-led businesses. And I haven't seen a study on the number in Asia, but my experience has been that is much, 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 much higher in Asia than it is in Europe or America. And so finding ways in which Asian investors and investees can leverage and point to the strengths and the areas where we're actually leading the world, I think is something we should be looking for as well.
Thank you very much, Tim. And I'm going to write that down also for something for AVPN to pay attention to, seeing as how we could be potentially a way to really leverage these kinds of leadership to the global attention. I wanted to pick up one more question, which is a little bit complex, but I think is worthwhile addressing. And I welcome anyone from the panelists to talk about this, which is in a portfolio looking at sectoral balances. To the audience member who raised this question, please forgive me for paraphrasing because your question is quite complex, but I'm trying to be conscious of time. If we look at a portfolio and there are different sectors that could your funds could be invested in, there may be impact implications or material economic implications in each of these different sectors. How do you look at the relationship between these sectors, and how therefore does that change the way that you balance the portfolio? As an example, there may be opportunities to see more outcomes from solar investments, but then there could also be other outcomes that you may want to see from financial inclusion. And how do you ensure that these kinds of sector balancing is aligned? And in what way do you, from an overall impact perspective as well, ensure that there is that we are not unwittingly perhaps even cannibalizing the impact from each other? I'm paraphrasing it. I apologize in advance to the audience member, but I thought it was a really interesting question. So I welcome anyone from the panel to respond to this.
When we go into any single company, we look at what is the maximum, the best version of itself this company can be. And actually, we don't do so much of a cross-sectoral considerations. So we are very invasive, specific, and activist orientated with the single business we're involved with at that point in time. So the question doesn't really resonate with me.
Understood. Stephanie or Tim, you've got portfolios that also have different strategies. What do you think about this question?
So for each product, each fund, we have specified specific core sustainable development goals, specific impact outcomes that we want to achieve. So usually on the basis of that, we kind of have a strategic asset allocation with regard to what type of companies we want to be investing in. And then we have also limits to that. So we do actually have also quite a structured approach how we allocate funds to which type of outcome that we want to achieve. And of course, that also is with regard to risk return characteristics. And yes, it does have effect also on the investee company, but that's something that we manage on a bottom-up level directly, as Praveen just mentioned, if that helps.
Tim, how about you? Any perspective on that?
Only to say that the ability to focus really on specific sectors is something we typically see out of kind of high impact focused family office type investors who want to achieve specific impact in a particular region or a particular area of social challenge.
Thanks very much, Tim. I think it's an interesting question also when we start looking at the surrounding ecosystem to your investees, and to be able to take that into account. Stephanie, coming back to your point earlier about being very activist and proactive in working with the investee to ensure its ESG and sustainability impact is going to be achieved with the funding that you provide. I wanted to maybe just raise one last question, and then we can wrap up the session because we are running a little bit past the hour, but I appreciate everyone's patience. There is a question here about what is the most efficient way to group potential investors together for companies that are seeking to achieve sustainability and ESG outcomes and see much bigger impact from investment. And I think it's an interesting question because all three of you are operating funds, which are by their definition already aggregating investment. But I'd love to hear your perspective about how else we can create the opportunity for scale, funding at scale.
Mm-hmm. So if I may add something to that, yes, of course, we have traditional fund investments where we pool different investors. But what we started to do more and more is also to issue bond transactions to the capital markets. And with that, we're able to basically offer institutional investors within 1 day, basically, an investment that is sizable and multi-million dollars in size. So we've issued, as I described, the social bond together with the Swedish government, and we had 2 institutional investors who took up to 100 million in size to have really impact at scale directly from one investment. But we've also issued something else where we felt we want to create different risk return profiles. We issued the so-called CLO transaction where we had risk tranches for different type of investors, also ones that want to have it more leveraged. We want to have a leverage impact portfolio, and they basically bought then the equity tranche, which is able to achieve a very attractive return. So I think that these are some of the instruments that will come out more and more, because as we see in capital markets area with green bonds, we would like to very much also replicate that for some of the impact outcomes that we are targeting.
Thanks very much, Stephanie. And thank you very much to the audience. You've got more questions and comments than we have time for. I would like to invite the panelists to perhaps look through the questions that we didn't get to, and if you would like to provide a written response, we're happy to publish this on our website. And we're also glad for the audience's patience to let us run a little bit past the hour. So unfortunately, we do have to wrap. And I'd like to suggest that the audience please continue to engage with AVPN members and our panelists on this topic. Funds are here to stay. This will be a very good way for us to explore how this approach can be a way to unlock more capital for impact in this region. I'd like to ask the panelists maybe just one closing comment for each of you that you'd like to leave behind to the audience before we say goodbye to them. Praveen, we'll start with you.
Okay. I would say that ESG is dominating boardroom agendas in India, driven by regulatory policies. Let's not forget that it was only in 2019 that every last village in India got electricity, and clean drinking water is still targeted for 2024. So there's a lot of basic work to be done to empower and include those on the margins. In other words, there's a lots of low-hanging fruit for making impact in India, and firms like ours are taking the lead to identify investment opportunities, to demonstrate measurable impact without sacrificing returns.
Excellent, Praveen. Tim, how about you?
I think I just encourage participants to explore what ESG looks like in the context of their company or their investment portfolio. We're really at the point now where it's not a matter of finding opportunities to invest in ESG in sustainable and impactful ways. There are opportunities out there. It may take some work to identify which ones are appropriate, but it's certainly a journey worth taking that first step on.
Stephanie, yourself?
I would just like to add to Praveen's comment. I mean, just a couple of years ago, this type of conversation would have not been possible. Right now, the kind of consciousness in the society, but also with investors, is a momentum that we all need to use. And we all know as well that we actually don't have a lot of time to actually fix climate change issues until 2050. So I think I really would like to urge also the audience to think about that. How can we use this momentum and really create a positive outcome to the planet and to the people?
Excellent. Thank you so much, all three of you, for your very practical but also very enriching sharing. I took away a lot, certainly. I heard from our conversation today that it is important, particularly when you are managing these funds, that there is an activist, I would maybe say very hands-on engagement with your investees, so that sustainability and ESG are developed in a holistic way, and not just only to report impact on paper. And recognize the ecosystem that these companies are in. Variety, diversity, dispersion is natural, given where we are in the stage of growth in this market and the diversity of this market. And we shouldn't let that be a barrier to how we can be making those investment decisions. And to also be patient, because this is new for us. As you say, Praveen, we are learning to read the alphabet, and we will, I'm sure, in no short readiness, be able to read the Shakespeare as well. So I think this is a really good conversation from all three of you, and thank you very much, audience, for very, very good questions. We will be wrapping up the session now, and we really appreciate your time today, and welcome those who were not able to make it to the session to please check out the recording on our website after we've been able to process and put things up. So virtual applause for all of our panelists and audience. Thank you all again for your time today.
Thank you.
Thank you.
Bye-bye.
Thank you.
Bye.
Bye-bye, everyone.
Thank you.